2014 in August, when the dollar started ripping, volatility pretty much doubled in a month. I held a New Zealand dollar long position the wrong way for like 6 months and fought my way out of a $20,000 drawdown to make $500 in profit. I'm just trying to give myself a lot of margin for error, generate income, be consistent, be mechanical, take defined risk trades, and take 4,000, 5,000 trades a year. Managing a losing trade in options is not nearly as difficult as managing an ugly drawdown that I've done in my career in forex. My stop loss is basically about a 500 pip stop loss, and about 45% of my account is cash for this exact reason.
Hi everybody, welcome to the Trading Battle, where we talk about trading with some of the best pros in the world. And today I have one of the greatest traders I know myself, Chris Pulver of Streamwise Capital and an analyst now at Prosperity Pub. Welcome to the show, Chris. Nice to have you.
Thank you, Boris. Pleasure to be here, and interesting 2025 as we kick things off, huh?
It has literally not been a dull moment since the year has started. The thing that's amazing about this year, I think, is that there's literally no one who has any idea of what happens in the next 3 to 6 months. It can go either way because, of course, the scenarios are so crazy. And we'll talk a little bit about that down the road. But before we talk about that, I want to kind of introduce people to your life story, which is a very, very unique way of you coming to trading. You've actually didn't start wanting to become into finance. You actually wanted to play golf, right? Tell us a little bit about your background.
Yeah. So when I was finishing up school in grad school, I started trading when I was 18 with a little investment club that my brother and I founded and formed. And so we had, friends and family and some of my brother's colleagues involved. He was a professor at a college, and we had like 15 members, and, we just met every month, paid some cash dues. We had some cash to work with, formed a multimillion LLC. We had that run from 2000 to 2020. So long story short, I've been in the market since, pretty decent time, 2000 to present. So 25 years in the market. But my thoughts of getting out of school were, rather than jumping right into the workforce, the career, I thought, could I do something to play golf? Could I do something to travel and get paid to travel and play golf?
You were a college golfer. You played on your college team?
Yep, and also I got my PGA membership as well. So I joined the PGA of America, and I thought, well, I can try to play, and then I can also teach as a way to pay for tournaments, a way to kind of have like a break-even hobby, travel the world, stuff like that. And I ended up getting hooked up with a franchise down in South Florida where I could teach, I could play, and then I could travel. I had pretty good flexibility. I had, it was a typical, usually a golf industry is service, right? You're working 7 days a week, holidays, weekends. Maybe one day off if you're lucky on a Monday. The last thing you want to do is be around the golf course. But I found something that was 5 days a week, and had a little base salary, had some commissions, and I could teach on the side and kind of side hustle and set my hourly rates and things like that. So anyway, I ended up just staying there for about a year or so, and I was tracking the whereabouts of this international PGA Pro that I've known for like 5 years prior to that. And so this guy, he's worked all over Asia, all over the UK, all over Australia, New Zealand, and I ended up getting hooked up with him in Vietnam. So he gave me a nice little offer to go take a work visa, go work 2 years, run a club in Vietnam, and then also I followed him again 2 years later to Singapore. And so I spent time in Vietnam, Singapore, traveled all over Southeast Asia.
Were you teaching golf there?
I was teaching golf, and one of the clubs in particular, Singapore Island Country Club, monster club, like 10,000 members. You could teach, literally I could teach for like 7 a.m. to like 10 p.m., 11 p.m. if I wanted to. They had stadium lights on the finishing holes, stadium lights on the range. It was a factory. Like you had 2 separate facilities. You had 81 holes of golf. You had 2 36-hole facilities plus a junior course that was 9 holes. And I could teach all day, every day, and that's all I did. And I was motivated by nothing other than money. It really burnt me out in the golf industry in general. And I thought, I've made enough money doing this. I've been trading. I get into, golf with finance from this little franchise in South Florida, where a guy that I met was a full-time currency trader, and he actually managed a currency fund. He had like $15 million just trading euro dollar. This guy traded like 50 to 100 lots a day, and we played a lot of golf together. But that's how I got started. And as far as like, he was an introducing broker. He set me up with my first GFT account. And then GFT became, FXCM, became Alpari, became forex.com, became Owanda, became now TastyFX. Like I'm all over the place from the FX side. So I've been at it for a while. But point is like, passive investing in the stock side for a long time. 2007 introduced to forex trading. One of the first things that I was shown, and this is what kind of wet my whistle was, here's a profit calculator. That means if you can just make 20 pips a day, here's that $10,000 starting account that turns into $1 million after 1 or 2 years. And it's like, of course I want to do this. So I tried to go out and make as much money as I could. I was trading, my little lunch period and stuff, or trading in the evenings, because, it's 12 hours ahead. So the US Open would be around 8, 9 p.m. my time in Singapore. So I grinded, and, it obviously wasn't a full-time job. I was just kind of scalping and trading like a little 2 to 3 hour window when I could. But point is, my motivation was work as hard as I can, make as much money as I can, build up a nest egg to come back and have, 1+ years expenses taken care of, a nice little nest egg of trading capital to then try to give it a full-time go.
Wow. So you came into this very well planned. I mean, most people who kind of try to do it off the cuff. To have 1 year of all expenses paid plus trading capital really gives you a good cushion to kind of stay, trade. You sound like a very methodical, organized person. Is that a fair assessment of you?
It's fair. It's fair, but also I'm flexible when it comes to pretty much life in general. So I mean, nothing's perfect, right? A lot of things happen, life happens, but I would say I can adjust on the fly very quickly. I think this is also something that's helped me, in trading throughout my career. So yeah, I mean, I came back ready to trade, and it was not a picture perfect journey. In fact, the guy that I learned from, I came back to manage money with him. We raised some capital together, and then we completely, like, our friendship dissolved and fell completely apart within like 6 months, because I was like, look, dude, I'm here to do this full time. Like, I'm not your seatbelt. I'm not the guy that helps you just put in a stop loss. Like, I'm raising money. I'm looking to trade. I want to grind. And I started to hate day trading. I started to hate scalping. I started to question the everyday euro dollar vol. It's like everything was changing. It's like I was open-minded, where it's like, I don't care how I do this, I'm going to figure it out. And so I started looking at, okay, swing trading, other currency pairs, and it just changed.
When you were doing this, when you came back, what year was that? Was that 2010?
Yeah, I came back from Singapore around 2010.
So the reason I'm asking this is because 2008 to 2010 was massive volatility. You could literally, euro moved 100, 200 points a day.
I know. And then it didn't.
And then, of course, we had the wonderful days of ZERP, where the whole world decided to go to zero interest rate policy, and the euro would move 100 points a week.
Correct. Yep.
And when you have that compression and volatility, everything that worked yesterday will not work tomorrow.
And you're exactly right. And that is exactly what happened. And so I was looking for alternatives like, hey, look, what about this, the Dollar-CAD? What about the yen crosses? I mean, we're hearing rumblings in 2011, 2012 about this giant carry trade. Well, I started to explore stuff like that. This guy didn't want to trade that, and I did. I didn't care what I did. I just wanted to trade something that worked. And one of a mutual, friend and just acquaintance, this guy was on a totally different level as a position trader. So, I'm learning as a day trader scalper, and it's stressing me out, which is not my style. I'm not a, high emotion trader day in and day out. Like, I manage my risk, I manage my emotions, and that's been my whole life. So I was just I could tell emotionally I wasn't really equipped or wasn't enjoying day trading and scalping. So I wanted to look to bigger time frames. And this guy that I did meet, one of the coolest things I've ever seen, he just took like a cocktail napkin and drew out what he's going to do on the euro dollar. And it took him 6 months to make like $1.1 million. He took a $100,000 position, sold the euro dollar, closed it out for like 1,100 pip gain. And it took like 6 months. And I'm just like, that is the way I want to trade. And, when I had, money set aside and I had a nice little nest egg, I could experiment a little bit, but it's like, I didn't have needs or expenses. Like, I was okay. And so I thought, man, if it takes 3 to 6 months to make a fraction of that return, I'd be happier that way in that style than trying to sit here and come in every day and feel like I got to press the button and force trades.
Now, you said something really interesting. You said you're interested in doing what works. And I think probably sounds like that, that value pretty much motivates everything you do, because you've certainly had a very, very different journey in trading from where you started to what you're doing now, not just in change of strategies, but in complete change of instruments as well. So one of the things, you started out essentially as a forex trader, as a forex scalper, then a forex position trader. And we can talk a lot about, you still do forex position trading, and we can talk a lot about that in a minute. But Now your whole focus and your impetus is really driven by the options market. And I'm fascinated by that because options is a very esoteric product still to. I mean, options obviously are very, very popular. Everybody loves options. Zero DTEs have become like the new gambling tools in the options industry. But I still think, you know, as sexy as they are, most people really don't understand them. And certainly, I know very few people that can trade them successfully. So maybe you could tell us a little bit about what your experience in the options market and how you decided to get into it, and why you think that's an attractive opportunity for you.
Yeah, so I'll go back to the investment club in 2000. So roll into, I returned back from Asia. We're still passively meeting and looking to trade. And so I started exploring a little bit more in options. And, after experiencing 2008, 2009, that account was down 35, 40%. It's like, of course, like everyone, it's like great financial crisis, recession, people are freaking out. It's like, well, look, we either trade through this or we just give it a break for a second. But it's like nobody, I mean, the good thing is nobody pulled out. We had plenty of profits in. Nobody was like sitting here like upside down. We had a good run, obviously, since 2000 to 2007, 2008.
So you were still net up on the equity was still positive.
Yeah, for that 7-8 year stretch, we were positive, but we did pretty much flatten out quite a bit in 2008, 2009. But we went, I mean, again, I'm not saying we were geniuses. We just had a couple of really strict scanners and screeners, and we looked at quality over quantity, and we ended up taking it. It took us like, 3 years or so to get back to our net highs in 2010, 2011. But it was at that time where I thought, are there ways to prevent that type of drawdown in our base accounts? And so options was what was really my best instrument to say, okay, I can either start trading futures to hedge, or I can trade options on our current core positions. And so that was where I started, which is like, and it's very basic, Boris. It is literally, selling covered calls or buying puts or doing like a investment banking 101, which is a collar position where you sell a call above and buy a put below. And basically if price goes up and appreciates, you get it called away, collect some premium, reestablish a new position of core ownership, same thing, repeat it over and over again. But that was the bare minimum, right? We've got upside appreciation, we've got downside protection. And every 6 to 12 months, we revisit these positions. So it was very passive up front. And then fast forward a few years later, and then I'm discovering there's more ways to trade options. There's more strategies. There's ways to generate options without even owning the stock. And so then I started looking at, okay, taking spreads and doing basic like bull put spreads or vertical spreads and trading directionally. And so that's what really started. So this is probably 2014, 2015. And also at this time, let's flash, a lot of this was motivated by forex too. 2012 to 2014, really interesting time in forex. 2012 was all about Japanese yen. 2014 was one of the, like, it was like my lightning in a bottle year where I made a fortune on just trading pivots, trading overbought, oversold conditions. Everything was efficient. Volatility, like you said, from 2010, 11, 12, volatility really contracted from 2013 and 14. And I traded a very range-bound, efficient strategy that made me a lot of money. And to this day was one of my best yearly performances ever. I had like 150% gain in my account that year. But in 2014, in August, when the dollar started ripping, volatility pretty much doubled in a month. I got caught in some really nasty trades against the dollar. I held a New Zealand dollar long position the wrong way for like 6 months and fought my way out of a $20,000 drawdown to make $500 in profit. Awesome trade that was, but I still did it, I've had some close calls over the year, but my point is like by necessity, I'm like, look, man, I've been trading this long and long enough to think I can't have one stupid event in the market be the reason that I am no longer trading or be the reason that I'm losing 10, 15, 20% of my account. So especially when I started picking up other people's accounts and I'm managing for this investment club and I start picking up other friends and family accounts, it's like, look, I need to start tightening up my drawdowns, getting better returns. And to do that, I started gravitating way more towards position trading, scaling and very small, using very little leverage. And that was essentially how I ran my currency fund until about 2023. Because I started to migrate more and more clients over into stocks and options. And then by 2022, I joined up with a hedge fund and I pulled pretty much everything that I had and I just put it into stocks, options, and we trade, futures. We could trade some forex, but it was basically like a stocks, options, and long short fund. So anyway, a long story short, now I'm doing it. I'm on my own shop again, just managing money for friends and family. But it is probably 80 to 85% equities, equity options, index options. You mentioned zero DTE. I trade zero DTE, but it is like you said, it is like the gambler's playground right now, and I'm not that guy. Like I am I'm trying to follow smart money. I'm trading what market makers do. I'm trying to basically be the liquidity side and, collect little bits here and there. I trade often, I trade small, and I get in, get out. And then I also have my 30, 60, 90-day positions. I leap trade, so I go out a year plus. My core positions that I own, I'm doing a lot of active management. And so, I mean, so far for the year, I think I mentioned to you, like I'm up, almost 9% for the year. S&P's up about 4%. That's a pretty good start considering I own very little. I've had diversification like crazy. I've got some gold. I've got some Bitcoin. I've got some silver. I've got some copper. I've had China since September of last year. I actually ran much longer than that, but September last year, China really paid me nicely. And going into this year, it's been, one of the better performing countries. And anything non-US has done well. Euro stocks have done well. So, you get to dabble a little bit. And I know they can be overwhelming for a lot of people. Like the nice thing about currencies is you trade 28 majors. Right? Like 28 majors and primaries and secondaries, and it's about it. But I'm telling you, man, like the days of scalping for me in forex is pretty much long gone. I'm a position trader now, and I've been sitting in some of the same trades for the last year plus. They paid really well when they're right, like Dollar Swiss. I told you earlier, Dollar Swiss. I was holding almost 30 positions long for 2 years, and I got paid at 9,200. Everything closed out. I was happy with that trade. It was well worth the wait. And I also got paid to hold it, which was part of the incentive. But I'm still holding Aussie Swiss, CAD Swiss, Euro Swiss, Pound Swiss, New Zealand Swiss long. I closed up my Swiss yen short for 560 pips. But point is, like, that's pretty much my exposure right now, and I'll ride those trades out. I'll scalp here and there. I'll swing trade here and there. But if you ever watch any of my live sessions, I am active in my stocks options accounts. Today I rattled off 20 trades today. Yesterday I did like 73 trades, 94 the day before. Like I'm active, man. Like
Wow.
that's what I do all day, every day.
Right. You're more active than I am. I scalp.
Yeah, I know you're active. I know you're active too. Yeah.
Let's backtrack a little bit because let's talk a little bit about FX because I'm fascinated with that. A couple of things. Can you walk us through the anatomy of the Kiwi trade, the one that went from $20,000 drawdown to a $500 recovery? What was the step-by-step process to even that trade out? Because I'm, curious about that. I always think that mark of a really good trader is not winning, but coming back from drawdown. Winning is coming back from drawdown is the true skill of good trading.
What's funny is it came from a place of great intentions, and it came from a trade that was actually right, but I just got greedy. So, I mean, I can walk you through it exactly if you want me to share the screen, or we can bring the screen up. What's funny about some of these big stories and adventures and journeys that I've had is you don't forget about them. And that's probably one of the most important things to trading too, is to make sure you learn from this crap and learn from these mistakes,
Exactly. It's
Okay.
your Moby Dick.
So it all started here. Like I was actually short the New Zealand dollar right here at this double top. I was short, okay? Now, when it scored a point right here, Boris, guess what I thought was going to happen? Well, we're going to form a nice little head and shoulders pattern up here, so let's go ahead and pull back, and then let's short it again. So I'm going to go, sell side right here and take that little run to those lows, and then look for a pullback and then short it again with a swing trade. That was what I wanted to do, and that's why I said it came from good intentions. But the reality was, as I bought it here, it just kept going lower. Okay.
Oh, so you actually, sorry, I thought you were short initially.
I was short right here, and I was closing out at that low. I wanted that trade, and I got that trade.
Then weren't you net neutral, or why were you long?
No. Nope. So I closed out, and then there was a weekly and monthly pivot combo that I thought, well, surely I've seen all these pivots get hit for 2014. I'm going to see this thing go up.
Let me chase it.
Yeah. So let me chase it up to that monthly pivot and that little cluster, and all of a sudden I'm down, 400, 500 more pips. And so here's how we get through it, right? Number one, I got a $100,000+ account. I'm trading, maybe $5 pips or so. So I've got plenty of wiggle room for a drawdown. I'm not saying I enjoyed a 20% drawdown. I certainly didn't, but I had the capital to kind of manage my way through it. So, other trades are still working out. Other trades are still hitting pivots and they're making profits, and that's all well and good. But the darn dollar changed the whole landscape in 2014 in August when volatility really erupted. And so, this trade, basically I scaled in every 100 pips. Okay. And I kept the trade size pretty consistent. And then I scaled in a little bit larger down here. And this was, let's say this is like half, and then
half
one.
Half lots.
Yes.
Every 100 pips. And then at about 500 pips, you started using one lots.
Yep. And then right there, when this thing came up, I was in a $20,000 drawdown that gave me about a $505 profit.
And I went, Thank you,
closed it.
Lord.
Yes.
Let me out of this thing.
And I remember that particular day, like I was so relieved. I'm not going to say happy, but I was relieved that like the stress and the weight of my account and some managed money all going back to black and all getting to a fresh high because I had other trades that were working just fine, but this trade out was just this was my
Well,
fight.
this trade was weighing on you, and this was, you said, as a
Of
25
course.
drawdown. What was it on a relative basis to the full account? Was it like a 10% drawdown to the full account, or was
About
it
20%, dude. About 20%. Here's my takeaway. 20%. And I thought, you know what? If I didn't get out of this trade with a
Yeah.
little gain and this thing went
Look
lower,
at that chart.
yes, and that 20%, and this is exactly why I had this kind of epiphany. It's like if that 20% became a 30, 40, 50%, it's like I'm not trading anymore. I'm not managing any money anymore. I am an idiot and I'm just another story. That was like the biggest experience to say, dude, you got to trade better than that, man. Like this is undisciplined trading. Now, what I did is I didn't necessarily deviate from the strategy, Boris, but what I did is I just traded way smaller. And so the next time this would happen, when we had this flush down, well, I looked over here and I found all this support. And so I did the same thing, but rather than starting at $5 a pip, I started at 1 a pip. So then I get all this structure and I dollar cost average in. And then I look at a price pattern here, Boris, and what happens? Well, now I get the price pattern to pay me. And I went from $1 to $3 to then adding to my winners. And this all of a sudden within about a 1 year period was my biggest aha moment of like, now I can make a crap ton of money when I'm right.
That was the epiphany, I think, that really amped up your trading.
Absolutely.
We went from, let me start small and let the market prove to me that I'm right. And then once I'm net positive, I can add to my position.
Yes.
Because so just to understand the sizing, you went 1 to, 1.1. You then the trade gets to sort of starts paying you, like, because you're averaged in. What's the scale? What's the upscale now? Do you go 2, 4? Like what's the sizing how does the sizing increase once the trade starts working your way?
I do a lot of this. So by this time I was with Oanda, and so this was my first dabble as a U.S. trader with non-FIFO, and so I was just managing better, managing much better than before. So I'd go 0.1, 0.1, 0.1, 0.1. This would be 4 entries here, and then when I get it right, I started going 0.11. 0.12, 0.13, 0.14, 0.15. And so I'm not getting too big on any of these sizes.
Parabolic,
But
very mild,
mild, and now non-FIFO. So I can manage a group and I can also manage individual trades. And all I had to do was get my measured move. And so this became a pretty easy swing where it's low, high, higher, low to higher, high. And I traded that all the way up, scaled in like every 50 pips, buy stop levels, swing levels. And I ended up building this up to like a, 10, 12 position winner that was like, okay, look, I took, I don't know, maybe $400 or $500 a drawdown here and turned it into like $3,000 in profit. And that right there is like, well, that's obviously way better than a $20,000 drawdown that makes $500. So let's do the opposite. Let's learn how to freaking manage a little bit more professionally, and let's just trade way smaller, way less risk. And then when I'm right, let the market prove it over and over, and then add to my winners, have some really conservative profit targets. And it just helped a ton. And so it's been a decade of that style of trading. And, I'm thankful that this is now like my wheelhouse. This is pretty much the only thing I focus on when I'm trading forex. And I trade forex this way pretty much exclusively. This is the biggest way and the most consistent way for me to make money.
Very simple, very clean, very efficient. Makes immense amount of sense. One of the things that I sort of find fascinating, and I used to trade similarly. Now because I'm trading scalping, I don't get a chance to scale into positions like you do. But I think it's almost impossible well, maybe not impossible, but I think it's incredibly difficult to do single entry, single exit. Like, it's very hard to do 2 to 1, one trade, be 50% accurate kind of a thing, unless you are, I have strategies that, that I've tested where you are, you got to be willing to take a 20% drawdown against a 40%. Like, you almost have to make investment like single trade ideas to make it work. Because otherwise, 5% stops, 10% stops, it doesn't matter. They're going to get hit way too much. It's funny. I was talking in scalping today. I was saying it's just as bad to have a tight stop as having a no stop at all. the end result is almost the same, because if you have a tight stop, you are dying a death of 1,000 cuts.
Can we go through one example? This is a perfect textbook example of how, my style, and look, I'm not saying my style is right. I'm saying that I just stay out of trouble because I trade small enough that the drawdowns are very manageable.
More money has been lost in Dollar-CAD this year or last year than any other FX trade. I mean, I've never heard more complaints about Dollar-CAD, but let's talk about it. Show me what you got.
So my Dollar-CAD position, number one, I was long since 3,400, and this was how this whole trade. This is how I planned on doing it. So we've got some shorts up here, we got some longs down here. So I was looking to buy into this thing around 135, 134, 133, 132, 131, and just play this area. Right, that's going to be my test. Now, I didn't get the trade down to 132. I didn't get the trade down to 131 like I wanted over here. But what I did instead is I got my 134. And then this started to break out, and you can see like, okay, we've got lots of resistance here, lots of resistance here. All I did, Boris, was stack up a bunch of buy stops. I went 4,000, 40.50, 41, 41.50, 42, 42.50. I stacked up my orders. I'm like, look, if this thing's going up, I'm going to ride this thing and take profit on a measured move. I take my low to high swing and my low to high projection, and that's my profit target. Now, here's another example of why, a little bit of lower trade size, a little bit more, like risk understanding can help. Because I was long 10 positions and closed out 10 positions at 44.90, right before the measure move that I wanted. Now, look left on this chart, and you can see a 2016 high that was beautiful, a 2020 high that was also right there, pretty much the same level. But look at the garbage that this thing played during that weekend gap, right? Because I told traders this. Everyone's like, Chris, you still in the trade? I'm like, no, man, I'm out. Like, I got tagged at this high like I thought I would, and I'm not going to short it. Like, I'm going to wait, right? And I'm like, if I'm going to short the Dollar-CAD, I'm going to short it basically at the 2020 high and the 2016 high. That's the best place to short it. So a limit order is great. But I know traders that, and I have traders begging me like up here when it hits this high, like traders have been stuck in a drawdown the entire time, right? Traders that are, trying to short this thing at resistance and they don't put a stop loss in, and now they're upside down from 38.50 all the way to 4,600. It's like idiots, but I get it. So everyone's begging for this to come down, but this is what the market loves to do. It not only tests this high right here once, but twice and three times. And Boris, this gap was almost a 300 pip run of everybody's stop losses right there, right? And so anyone that's trying to sit here and call this and be a hero saying like, I think I got the top in the Dollar-CAD, it's finally going to turn. It runs your stop once, twice, three times, four times. And there's no way that you can say, I'm going to put in a 300 pip stop. Nobody's going to do that.
No, and I think this is such an important point. And, you obviously see this on a micro scale scalping all day long, is that if you're using very tight stops, the trade will test it once, you get stopped out. We'll test it twice, you get stopped out. We'll test it three times, you get stopped out. Your signal is legitimate, yet you've made 3 or 4, or sometimes even 5 losses in a row. That's catastrophic for anybody who's trying to manage risk. That's what I mean about, sort of tight stops. That's why kind of a staggered, more measured approach where you're able to just ignore the noise.
This is the trade, right? If you like this trade, short it here, put in a pending order right here. You got one entry, you got a second entry, and what happens over the weekend? The thing gaps up, you're getting filled, but your break even is basically right here. And within Monday's trading day, you're already in profit, and this thing goes exactly where you want it to go. Now, the only way you can stomach a trade like that is by trading small. Test your micro lot, test your mini lot. Don't put any big money on there, but you got to be flexible. I mean, my stop loss is basically about a 500 pip stop loss. Meaning, if I'm dead wrong, and I've got an example here. Again, we learned through these examples. I was an idiot that fought dollar-yen short. I was short dollar yen in 2022 like a fool, but I was long everything else. I was long Aussie yen, euro yen, pound yen, everything else. But for some reason, technically, I'm like, the dollar yen looks the best. I'm going to short it. Dude, I shorted this thing at 120 and I rode this thing literally to 150. Now, here's how I learned this. Take me back, to 2014, 2015. It's like I've been in situations like this. Now, I managed this trade, and I would say the coming of age of me as a trader was exemplified in 2022. And here's why. Because I had the discipline to lose. So the 120 trade that goes 120 to 130, I closed out of that trade as a loss, and I got back in at 130, and I closed out that 130 at 140, and I continued to just do that and leapfrog. Anytime I take 1,000 pip loss, I would just close out that one position and then add back in. So I've got some losses, but what I did is I kept adding, and eventually this trade was like, okay, so I've got a loss here, loss here, loss here, loss here. And once we got to 150, and we're hearing all this garbage about what was it, intervention, and that's about to happen. We saw it a couple times throughout the year. The 150 level, I stood a little bit more firm, and I thought, okay, I'm going to build a position between 150 and 160. And I was willing to put my foot in the sand.
Just to understand, you were doing a single lot entry, 120, 130, not adding anything. You were just like, let it, if it goes 1,000 against me,
Correct.
Goes 1,000 against. So this was like, you literally had about, wow, it's tremendous.
6 months, dude. 6 to 8 months of this garbage. I'm an idiot.
Bleeding 1,000 pips, but basically like $1 a pip, right? So it was like $1,000 down, $1,000. So you're like, okay, $5,000 gone, but now you're at 150. So what happens at 150?
So I'm down about minus 5K, and then once I held the line at 150, and then I had a 150 to 160, and then once we got back down here, I started adding buy or a sell stop, sell stop, sell stop, sell stop, and we had a swing, high, low, lower, high, lower, low, came all the way back down to my daily. And by the way, Forrest, this was actually my target. The whole time I took this trade was based on a bar count from all the way back here on the 200 moving average. So when I started to get this direction, I was shorting this all the way down to the 200 moving average, and so this ended up being about a 9K winner on the way down. So I lost 5, made 9. It wasn't a great trade. I felt like an idiot the whole time complaining that the stupid dollar yen won't go down, but I still made net profits as an end result, and it helped because 2022 was also not the easiest year to trade the stock market. We had a 25 to 35% drawdown, bonds are down, equities are down, Mag 7's getting his butt kicked, and then eventually, Q4 we kind of got out of it. 2023 was a great bull market, but my diversifier of forex, I still managed to carve out some nice wins on my yen hedges, but also I was just riding this trade like a buffoon, but ended up making it net profitable. So I would say all the lessons learned, 15 plus years in forex trading, 20 plus years in the markets. Biggest thing that saves me is just risk management. Risk management's the biggest reason that people can survive and stay trading and make money.
Yeah, super good lesson. Thank you for that. Now, speaking of, what I'd like to talk about is next, you serve your evolution into stocks, options, and everything else. And it sounds like you do some very active trading. So let's just kind of start with options. What type of, it sounds like there's 3 things you do. There is sort of a positional trade in leaps, which is actually a stock substitute idea, I would imagine, right?
Yep, pretty close.
Then there is more of a quarterly positional, like sort of a three month expiry type of a situation. You're looking for event trading? Is that
Yeah, it's a couple of things. So I would say there's certainly a seasonality that I'm interested in trading, right? If I'm going to be bullish throughout the year, I like the, January to April, May window. Like that's a pretty good bullish window. If we've got a strong enough push, then maybe it drifts into the summer. I'm a little cautious going into August, September. Markets kind of top and bottom. We get some seasonality effects, but then like October to December, also seasonality pretty bullish. So, I mean, for the most part, if I position for options, I'm looking at like, okay, let me put in some, when the year starts, I'm going into February, March, April, May, staggered expirations. And that's pretty much my first chunk of trading for the year is how do I position? I give myself a lot of margin for error with a lot of these trades. So if you're asking for like particular strategies, a lot of them involve ways that I can allow the asset, like an index, for example, could drop like 10 to 15%. And I could still make money on the trade, and I can stagger that out over.
How would you do that? How would you give me an index, give me an example how you could make money even if the index goes down and you long.
So I think I did a trade this morning on QQQ. Let me verify that right here.
Which is NASDAQ.
Yep. So NASDAQ QQQ. Yep. So I did a trade here out to May. So it's 85 days out from today. I took the trade today. So here's what I did on QQQ. I put in a trade. We're sitting here at 537.70. So just off the all-time highs. Sorry about the noise on this chart. Let me just change this up so it's a little bit neater for Boris. I need him to see all my charts. Okay. So QQQ, let's get to current price. There we go. Okay. So on the daily time frame, just to get a context here, what I'm looking at is I think that this market, and we talked about this earlier, like nobody knows what's going to happen in 2025. I certainly don't. But I think this market could either blow these tops off and just keep running higher and climb the wall of worry, or this market's going to have this nasty election reality where we've got tariffs and DeepSeek and AI and China and everyone's outperforming and who the heck knows. But right now it doesn't seem to be the case. But if we fall, Boris, I think we could fall easily 8 to 10% easily before the dip is really bought.
We've been through this kind of, I think you've been in the markets long enough. You get a feel in your stomach.
Yeah, man, it's definitely an intuition. And it's not, I'm not saying that I'm right, but I am saying that if it happens, I am ready for it. So I'm literally in about 45% of my account is cash. for this exact reason. Because if I get an opportunity that's going to offer up a major discount and a major flush, I'm going to be hopefully buying a pretty nice V-bottom like we did back here in August, like you did back here in April, like you get some of these nasty pullbacks that happen. So here's how the trade looks. I'm doing a trade like this. I am buying a put basically right here at the money, and I'm selling a put right here to make a little bear trap. So this is about a $500 bear trap right here. So if price goes up, I'm going to lose on this trade, but I pair that with a slightly wider credit spread down here. So I pay about $1 to make $5 on this trade here. Okay, so there's a reason that I do it, and then down here I go a little bit wider, and I can collect another like $1 to $2 of credit.
How wide is that?
It's pretty wide. It's like 50. It's like 50 wide. So I'm not messing around because I have enough cash that I would own the asset. So I did a 490 by 430. I went 60 wide.
Okay, you're 60 wide to collect the credit, and then on the put side you are 5 wide.
I'll give you the exact trade. Okay. So I bought a 535 put, and then against that I'm selling the 530. So that is a bear put spread, which if price goes down, that's a $5 trap. And then all the way down here, I sold the 490 put and I bought the 430 put. So that gives me so this is a credit spread.
Right.
And this is a smaller, narrower debit spread. What's that?
When is the expiration?
May 16th.
So this is what's that, 60, 70 days forward?
85 days from now.
85 days forward. Okay.
So the margin for error that I have is we could come back down to a nice technical level, which would be about a 9 to 10% drop from recent highs. If we hit that 200 moving average, that's 488. I've got a 490 strike. So we'd have to drop about 9.5% in the next 80 days. I'm not saying that we don't. I'm not saying that we do. I'm just saying there's a margin for error that I think if it happened, Boris, I'd be happy to scoop a dip up. That's all I'm saying. And I also wouldn't mind owning the shares if I had to own the shares. But at the end of the day, for my IRA accounts, it's defined risk. For my margin accounts, it's like nothing at all to own 100 shares and flip it and repair it. So I'm going to take it that style. Now, I've literally been doing this for years of just like, look, if I don't know what direction it's going to go, or if I'm not crazy aggressively bullish, I trade a lot like this, where I basically buy myself a little margin for error. And then I'm willing to do like on some of my like margin accounts, I can just do a cash secured put. But I can make defined risk here, so I can still generate, it's typically per trade about $200 to $300, every couple of months. And I scale that up on different, obviously the contract sizes. But as far as ownership goes, like I'm only going to own for any given account, like a lot of the accounts I manage are, $250,000 to $600,000. I'm only going to own like 100 shares at a time. I don't care about owning 1,000 shares of SPY or 1,000 shares of QQQ. I only want like 100 shares at a time. So I'm tying up like maybe 20 to 50 grand of buying power. And then the rest is just options.
Okay.
Does that make sense?
So
if you're familiar with the risk profile graph, this is what it looks like. So if price is right here, okay, if price goes higher, I make money. What it looks like to the downside is we can go all the way down here, and I'm actually bringing in credit. This is my $2.05 credit. It's actually $2.04 credit. And then I have a profit trap that looks like this, and then I have my risk, right? So the nice thing is it's still defined risk, okay? So I pull on my 204. I have a 704 profit trap if I'm right, and then I have a risk of around 6. That's actually like $300 is my risk. But I'm not going to take on that risk because I'm going to own the underlying if I had to. So I'm still going to repair the trade.
But the question I have is, so you're going to stick through this. You're not like, I was going to say, what if the scenario is, 30 days forward, we're at 500 QQQ. You're still in the trade. You don't care.
Still in the trade.
Because if you're at 500 QQQ, you're net positive on the whole position still.
Yes.
You don't adjust. You don't roll. You don't like say, okay, I'm gonna collect this. Maybe sell the put down and roll the credit a little bit down. No adjustments.
No adjustments. Very, very few needed, because here's why. As long as this trade is staying profitable and I'm just letting the time decay work in my favor, this trade is a free hedge. That's all it is. That's a free hedge.
Well, that trade would be like $4.50 at that point. Like we're at 500.
Oh, of course. And I'm saying like I can take it off for like 95% profit, 99% profit, just get rid of it. But I can still have this one. And then if I wanted to, I've got the flexibility to roll it. I can go out another 30 to 45 days, roll it down. But I don't like to roll for a debit. I'd want to roll it for more time and get a credit for it if possible. So I'd probably just roll the put. I'd probably just roll the 490 put. Or honestly, I'll take the trade and really, I don't want to do anything. I don't want to do anything because the trade is what it is to me.
Do you ever close out the bull put spread at like 95% of profit? Like, if it's at four and a
Yeah.
half.
Yeah. Capital efficiency wise, like, so here's an example. If I collected, let's say I'm doing some type of credit spread, if I pulled in $1 credit and that thing is trading for like 10 cents or less, I would rather take the 90 cents profit and walk away and have that just return to capital, go find another trade, as opposed to I'm going to wait another 30 days to grab 10 cents. Like, fortunately for me, I don't pay an exit commission on my options trades. So it's entry only. So I'm like, for me to get out, I just want to get out and I'll put that 10 cents elsewhere. I can collect the premium out of the other trade.
I meant for debit trade. So you're paying $1 and now it's worth 4.5. Five is the ultimate. Would you take profit at 4.5?
I would. Yeah, I'm fine with that because it's like, what am I going to do? Wait and wait for another 30, 40 days to get the extra 50 cents or just take the profit? I'll take the profit.
Yeah. Because it's capital efficient as far as stuff. Interesting.
Correct.
So essentially, that's very, very interesting. So you basically, again, try to hedge every trade or at least trying to create a scenario that can get you at very worst break even most of the time, but paid quite a lot of the time without really being committed completely to the full scenario,
Yeah. And a lot of times what it feels like when I'm trading options is as long as I just set a chart alarm and I know my price level, I just have to monitor it. It's just easier for me to manage where it's like, I don't care about the wicks and the highs and the lows and all the noise like we get in futures and forex. Options is I put in that line in the sand. If we're above it, I make money. If we're below it, I might make money. If we're, there's a plan A and a plan B and a plan C, and there's always time that you can get yourself and typically, have like a little bit of longevity in the trade. You can survive a trade a little bit longer. You can, improvise in a trade a little bit if you need to, but I'll say this, managing a losing trade in options is not nearly as difficult as managing an ugly drawdown that I've done in my career in forex. So, to me, it's just tighter. It's like I'm willing to accept the risk way better.
Trade, it's defined as a trade by great definition, as long as you're not naked. And I'm sure nobody's going to trade naked. Speaking of naked, by the way,
I was going to say, I was literally going to say that too. August last year was a close call for this is why I trade defined risk. That August drop we had from July to August, I did trade quite a few of that similar trade style from like it was basically like May to October. And so I had to deal with a futures market that was essentially illiquid on August 5th. And basically I saw and this was, I know a lot of good traders that lost, what they typically have a very disciplined 200-300% stop loss on their, naked or cash secured securities, but they got hit for like 800-900% losses and they got smoked during that move. So this is why I trade defined risk, because I don't want to ever have that type of outlier risk, and so I'd rather take. So look, I could have taken the trade today on QQQ and got filled for like $5, but I opted to take the $2 fill because there's still a profit trap and it's risk defined, and that way even for IRA accounts I can manage it and it's pretty easy, as opposed to just a naked put, which if things go crazy and we get like this big squeeze and gamma's going nuts and then your deltas are changing dramatically, we get a big flush down, which you and I both know. If this market's going to let loose, I don't think anybody should be surprised to see like a 10%. Like in a week, we could see like a 10% flush. Just don't be surprised. That's how wild this market is right now.
I mean, naked put actually does have a turn. Like there is a stop loss, which is, the zero level.
Yeah.
The real danger in options is the naked call, which is unlimited.
Oh, for sure. Well, imagine somebody dumb enough to do this. I'm going to sell a call in Palantir, and they see it just go. It's like, this is the story of GameStop. This has been the endless story. This is why Hindenburg just closed up shop, because you can't be a short seller in these stupid markets right now. So I'm not trying to be the hero. It's like, I'm just trying to give myself a lot of margin for error, generate income, be consistent, be mechanical, take defined risk trades, and take 4,000, 5,000 trades a year. I'm fine doing that. It's a lot easier to me.
Like, why is it because every single trade is like one contract, basically? Why so many positions? Just because you're really like your max risk in any like this. Well, I'm sorry, we're looking at the Qs. This, you said 100. That's basically one contract. This is basically one contract. So at very worst, you're gonna own 100 Qs. You're not gonna be get killed by that.
Right. And there's a way around it too. I trade a strategy that also I'll take about 5 to 10 contracts a week. But with that strategy, if I was ever assigned, I'm dumping, let's say I take 10 contracts. Okay. Let's just say I do. This is a terrible example, but I'm just going to use it. So let's say that I sell the 538 put and I buy the 537 put. So that would be a credit of maybe like 40 cents credit. Okay. So if I did that for 10 contracts, my max profit would be $400 if price is greater than 538 by expiration. I'm going to do greater than 538. Okay. But this happened in December with that FOMC announcement and that big spill we had December 18th. I did get assigned on the SPY. I'll just use the same example here with the Qs. So if I'm assigned, okay, I dump 9 contracts and I keep 1.
Just to run the mechanics of that, you dump 9 contracts essentially for 60-cent loss per contract. So that's 6 times 9. It's
right there, $540.
$4, right?
Right. And then I keep 100 shares long. And if I also close out my long put, let's just say I get a break even of whatever. I get a break even of like 535. I'll throw a random number. So let's say I'm I close out long put, and I keep the shares, and my net break even would be 535. Well, if I close QQQ at let's say 540.50, I'm back in business, right? That's a $550 winner, and I'm only down $540. So I can repair that stock pretty easily. And what's nice about this, Boris, is how much do you think you get for like a 30-day call option on the QQQ?
3? I don't know. Like
let's look. So if I go out 30 days, I'm going to go out 29 days. I can get $9 to $12 for an at the money. So just in 30 days, I could essentially turn this to like a $3, $4, $5 net winner, as opposed to, I dump 9 contracts. I take the loss of $540. I own 100 shares, and I do a 30-day covered call, and I get it called away, and I make $1,000 on the upside. I lose 540, make 1,000. I walk away with $460. Everybody's happy. It's like you wash the losses so much easier with just trading to find risk and having some of this plan B, plan C, little backup plans with options.
It really gives you a tremendous amount of flexibility, for sure.
Tons.
So let's talk a little bit about markets. This is a interesting year, as we said, and you said you're doing a lot of positions, obviously very small sizes. Is there any areas of the market you love? Any areas of the market you hate? And we can also talk a little bit about commodities too, which is a really separate conversation.
Okay, so areas I'm enjoying. Okay, gold is outperforming everything right now. It's either like this big alternative play against the dollar. It's a safe haven play. It's an inflation play. It's everything that makes gold attractive. It's doing and there's a resiliency to it. I think this is going to run up to probably 3,000 plus and maybe tag those levels. But I will say I have been long gold since 2023 and 2024. And I'm still holding on to GLD, and I'm still doing a bunch of option trades, but I have not added anything, Boris, since this dip right here. I haven't added anything since these dips. So this run up, all I'm doing is holding shares and letting my time decay, premium decay work in my favor with my sell options. I want this thing to come back and find a moving average, a 21, a 50, a 1, anything. I want it to find a previous high. So I don't know what is a turning point for gold, but I still want to buy the dip. I just don't know if I'm going to get the one that I want, or I'm just going to be patient to wait, because right now it's nice to see it going up. I think it's starting to get a little stupid. I think it's starting to stretch a little bit higher, but gold and silver, I think, are great diversifiers this year, and I'm bullish on both of them. Bitcoin is becoming a whole new animal because of the securitization and the big hats in the ring with the ETFs. I mean, I don't know. I know you trade Bitcoin a lot. You scalp a lot. I was accumulated Bitcoin this entire time. Lots of credit spreads, lots of debit spreads out through the election. I basically positioned my Bitcoin all the way out to December, January.
Through ETFs? Were you doing it through the Bitcoin ETFs? How were you trading?
I did a lot of IBITs for the accounts that I manage. So I've got my own, I've got a Coinbase account, I've got a Ledger account, I've got some off-grid stuff. But I started doing, for the managed accounts I have, I just did IBIT, FBTC, started to use the proxy, MSTR, a little micro strategy, 2 to 3 times leverage Bitcoin, which is insane. But it all worked out pretty nicely. So my point is, I just think that we're almost going into this new personality of Bitcoin, where I just think you're going to see a lot more accumulation cycles. And this could either be, if the market doesn't blow up on itself and we start going higher and making all-time highs, then Bitcoin's probably going to go higher as well. My concern is that this area would be retested, and we have that dip that I'm talking about, like the 8, 10, 15% correction in the stock market. Bitcoin goes with it because it's certainly a risk-on asset. But I still like, again, risk capital for me, but I still like having some 3 to 5% exposure in Bitcoin. So I like gold, I like silver, I like Bitcoin. I've taken a lot of directionally neutral trades on oil. I don't know what you're doing on oil. I do a lot of iron condors, and I don't do strangles much because of undefined risk, but iron condors on oil has been fine. I'm long natural gas, though. This has actually been a pretty good move for me this year. Natural gas to me is a bigger trade. In this one, again, I'm doing with options. I've got a 5x23, which is just a fancy, I buy a call and I sell a call against it, but I'm doing it at a different time. It's a diagonal spread. So I'm out to 2027, which means I'm buying a ton of time, but this trade only cost me about $11 and my break even is 16, and I'm already up trading towards like $19 to $20 profit.
It's the same duration, but different strike prices, or are you doing different duration when you're saying
different? Yep. So my long option is out to January 2027. My short option is actually April of this year.
Oh, I see.
So it could get called away. Yeah, it can get called away, and I make my max profit here would be $18. So if I make $18, but my risk is $11.25, I net like $6.75 on the trade. Return on risk wise, that's pretty good, man. That's pretty good. That's bigger reward than risk. I'll take that. Yeah. So I like natural gas. I'm trying to think. Copper, I think, my call on copper this year was if China's going to recover, I think copper looks good. So I've got some copper exposure here, a lot of support. I'm still long on China. I just started to dabble in the DAX a little bit. So I trade FEZ for the Euro stock.
Yeah, which is the kind of, I guess, a proxy for.
Yeah, it's like an ETF. I mean, it's not exactly the same, but it's close enough where it's like I can't trade DAX, and so I want to see. I think DAX catches a bid. And I don't know really what the why is. I think a lot of it has to do with, the fiscal policies that are changing throughout the world, and also the fact that everyone's been told that the U.S. is American exceptionalism. The U.S. is outperforming, just buy U.S., just buy tech. And now we've got a rotation into the most beat up and hated and uninvestable assets in the world, which is don't trade China, don't trade Euro. And now they're crushing it this year, double-digit gains.
Yeah. Also,
just go figures. Contrarian.
I wonder if the equity markets in Europe are anticipating a more market-friendly regime all across Europe.
Yeah, very true.
AFD is number 2 in the polls. Even if they don't win, they're going to have a massive influence on policy. And I think a lot of Europe, it's going to be interesting to see if there's going to be a lot of deregulatory reform in Europe,
sure.
which will be
which would be big, because that's probably the reason Europe has been so bad, is they've been so much on restriction. Right. And not enough. So, I mean, that deregulation, I think, could do nothing but help.
They're coming to a realization. I mean, the interesting thing is, I've had a chance to travel to Europe this year. The most vibrant, dominant, effective part of Europe is Eastern Europe. It's like, the part that used to be the poor Europe now is the rich Europe. Poland actually has GDP equal to Japan at this point. And
wow.
It's Poland, Czech Republic, Hungary. Those are the dominant economies in Europe. Whereas the old economies, Italy now moving rightward has really improved tremendously under Giorgia Meloni. But France and Germany are sucking the life out of the Europeans, and they need to convert. So if there's a massive move rightward, I think in terms of more market-friendly policies, that's maybe what the markets are anticipating. It's kind of interesting.
I hope so. Yeah.
Gold is definitely an interesting story. Gold certainly looks a little bit stretched, but I got to tell you, gold is a chaos agent. I mean, gold is. I have a feeling. I mean, there's, we're all following the stories of that there's no gold for physical delivery in London, and now they're looking to see if there's gold delivery in New York, and there's possibly short squeezes. But besides that, I think there's sort of a, the world is becoming very fractured. I think macro, you're looking at it, it's almost like pre-World War I type of, situation where we used to be very unified, unipolar world. Now it's becoming a very multipolar world. When you have multipolar world, it's just chaos, and there's chaos. People run to gold. I think that's.
So the thing is, I'm not calling a target on gold. I'm not calling a high. It's like I was very aggressive on gold last year, and I hit my technical measure moves. I'm actually more bullish on silver just to see if it's poor man's gold. Like, it's a fraction of the price. I can measure it because we actually had highs in the high 40s before, and now silver's trading at 32, 33 or 31. The ability for silver to stretch to maybe $36 is my first target, and then maybe up here to $48 is like my big bad target. But I can't measure gold all-time highs.
So given your predilection towards options, how would you trade this through optionality?
So this is a lot of what I'm doing. Yeah, there it is. So
like you read my mind.
So I've got a diagonal spread, which is going out to 2027, and against that, I'm shorting it. So this cost me $13.90, but I'm getting a $19 upside. So it's a little income generator that I can sell against, and I've got plenty of time in that trade. If I have any dips and pullbacks, I add more credit spreads like this, and so I just generate the income. I've had shares of SLV for the last couple of years. I've had shares of GLD for the last couple of years. So the one thing that I would say, if I really like a position, I trade futures. And so like gold futures and silver futures, I'm doing similar options trades on them like I do in the NASDAQ and what I do in the S&P. But this is a trade that's kind of set up the same way. I think this is a good line in the sand. This trade, let me see if I can get a silver futures position and see what it would pay me. I'm not sure what that translates into, but let me just put on a trade here at 0.06. Okay, so this is a $300 position right here. So if I get this one paid out, that's a $300 position. And it's about a 96% chance of profit. And I don't think silver is necessarily coming back to $26 anytime soon. If we go higher, and this is showing, 275, 280, 290, I'm obviously going to take the profit. I'm not going to worry about the risk. But if I get a dip here, Boris, like if I get a decent dip, I'll do the same thing and I'll just set another position with a line in the sand, and I'll do an April or I'll do a May expiration, and I'll stagger these out where I think that price is pretty safe here. And if we go higher, all those pay out and they get staggered out over month after month after month. But
when you're doing that, the trip, this is a it's like two butterflies, or just it's basically like
it's I'm doing it. So I've got my buy put and my sell put creates my profit trap, right? And then I have my this one I'm just doing. This is a naked. I'm doing the 26 naked. Which isn't great because there's obviously some undefined risk there. But the odds of this over the next, 30 days going down, I mean, silver would have to drop how much? Oh, I don't know. Probably some type that has never dropped that much before. We'd have to drop 21% in 30 days. Unlikely going to happen. Anything can happen. But I'm willing to take the risk. So that's what I'm doing. I also have a way out of the money hedge.
Like, just for argument's sake, let's play the devil's advocate.
Okay.
We have, I don't know, whatever situation, silver, we have liquidity problems in all markets. There are no bids anywhere. Silver opens, I don't know, 20. Do you cover the naked at that point?
I just roll it, dude. I got to roll this.
So
if it's out to March, I'm going to roll it to probably May or June. I'm going to roll it and just try to sit on it and survive it. I've got to roll the whole thing. Though this one I can take profit on. If this one's down, I probably take profit on that bear put side, because that's my debit spread. That's going to be my profit trap. But I got to roll the naked because I got the most flexibility there. I can roll it out in time, possibly roll it down even in strikes, and still roll it for a net credit. And that helps me survive the downside a little bit.
Got it. Okay. Interesting. Yeah. Well, obviously at that point, volatility is going to be much fatter. So you'll certainly get a better credit.
I'll get a huge premium for it, that's for sure. But obviously what you want to make sure that doesn't happen is you're not sitting on like a 1,000% stop loss. You're like, oh crap, I didn't define this at all. But I do define it because this $26 is actually sitting down here with an out of the money put. That is like 5 contracts and it's dirt cheap. Basically this one cost me like $100. And if we were to open up at $20, this $100 would probably be worth 10 grand.
Oh, so where's that put at? The one that's the $5?
It's at 20.
Oh, is it 20? Okay, so you do. It's not really naked. It's just it's
just wide. It's wide.
It's quasi. Yeah. It's just wide. It's so wide that it could almost be.
Correct. It's essentially like synthetic. It's synthetic. I don't know if that's a thing, but that's kind of what it is.
In order to avoid.
Yep, the big buying power that you need for futures, especially, or anything for assignment. Yeah.
Fascinating. Wow, very good. So ultimately, the bottom line is you always trace out worst case scenarios. Make sure that there's at least some, a terminal stop there, the worst case scenarios. But overall, basically, you put yourself into a position where it's so unlikely that any of this stuff is going to happen. And the most likely scenario is just going to collect and get paid. And that's really what you're looking to do. You're just looking to collect and get paid on almost every single position. And occasionally, if you're directionally right, then you'll get paid out, big on the delta position.
Yeah. I'm trying to think this, I mean, I can highlight some good stuff here. I mean, I was long Alibaba. This was a great trade for me this year.
I was going to talk to you about it because I was going to tell you about it's funny. I posted just a couple of days ago that I thought, the Baba, I think that the 10-point call spread 3 months forward was a 1-to-3 risk reward ratio. And I said, it's a great risk reward ratio. And of course it's like pretty much in the money at this point.
Yep. It's been wild, man. I mean, I had, and look, I was excited about this trade, when everyone started to talk about it in September, believe me, I was already riding out these trades for the last year. So it wasn't really that exciting for me outside of like, huh, I'm finally right. Okay. So now what am I going to do with it? So when I started positioning back here, when this thing was just like a slow burn to the downside, I just did lots and lots of credit spreads, lots and lots of debit spreads, lots and lots of naked puts and out of the monies. And, eventually it's like when this thing bottomed out, I just had all these staggered positions that started to pay. Once this trend line broke, I started to get more bullish. We had that rip in September, took some profit, reloaded, and then I just did the same thing with some ownership, some options, some active everything. And it, so far so good. So, but I'm not greedy, man. Like, I don't know what Bob was going to do. I really don't care. I got what I wanted. I turned about a 3% position into like a 6% gain. I'm happy with that. I don't care. It's like, does Baba go to $200 because it's AI? It's the best China AI stock? Maybe, but maybe it comes back down because a 60% rally like this comes back 50%. I have no idea.
Well, there was a lot of positive headwind on Baba from
Of course.
The numbers were great, and Jack Ma was in the same picture as Z, which was the absolute. I mean, that's what drove the stock to the moon, because people said, "Oh my God, he's back in the good graces." That means that the play is there, because then Baba can become again the dominant AI player in. Although I played with their AI, and it's nowhere near as good as DeepSeek. But
so speaking of on that, what do you do for like the AI stuff? Are you in Grok? Are you in Copilot? Are you in anything?
I literally have them all. I literally have
okay.
I have a little folder you can see it on my Chrome screen. It's called AI, and I have Anthropic, I have Claude, probably still the best coding AI there is. I have the latest. I pay for GPT. By far, DeepSeek, in my opinion, is the best. The problem is it's been destroyed by popularity. I was in DeepSeek about 3 months ago when nobody was there, and it was so good.
Wow.
Now, you try, even at 4 o'clock
It's bottlenecked, right? Like the user base is.
I would say we're just too busy.
Yeah, I got you. Okay.
Like the model is tremendous. It's a very, very good thinking model. It's excellent at a million different things. If you have privacy concerns, then it's not a place for you. But if you just want something done, DeepSeek is great. Although I will say GPT has really, really come back and done very well. So I would say rank it. DeepSeek, GPT for general purpose, and for coding, Claude, Anthropic.
Yeah, nice. Okay. It's been a fun little dabble. I mean, the last year or so, getting more and more into it, content wise and just idea generating. Like it's been really cool. And I think that, this is not the most rosy conversation, but look, tech is cutting jobs, man. Like tech's cutting jobs, Chevron's cutting jobs, JP Morgan's cutting jobs. You're not willing to come back to the office. This is like this like hidden headline that not a lot of people are talking about, but dude,
or just like they kind of still in that mode of like, oh, the general economy is good. It will take care of all those sins.
5 years from now, or sooner, it's like we could have a 10% reduction of the workforce just because everything can do more with less. And again, it's like, it's not being priced in right now. It's obviously not a concern because margins are high and earnings have been solid and all that's great. And this market can climb the wall of worry like nothing else. But my gosh, man, 5 or 10 years from now, the job market is going to look so different.
Quotas that we're getting $500,000 are going to be few and far between. Those jobs are, if an idiot like me can code strategies,
and again, at some point the market's going to care, and I said this during, we had super hot inflation data come out, last week or the week before, but the market doesn't care right now. Tariffs come out, doesn't really care. Trump says things every day, market doesn't really care. It will care eventually, but it's like I'm not the one that's trying to be like doomsday, like run for the hills, put your money in the backyard or buy gold bullions from Costco. It's like, stop, just trade the market. At some point the market cares. This is why I've got 40 to 45% cash, and that cash is collecting unallocated. Like I trade GOVT or BIL, so I get like short-term treasury yield at like 4.25, for whatever. That's fine for unallocated, but then I pull it out as liquid and I can put it in and deploy it when I want to. But my point is, like, I'm prepared for this. I don't think this is going to be a 20+% year. If it is, I'd be shocked. And I think this is also getting into like bubbly territory. If we had another blow off, 20% year in the SPY or 20% year in the NASDAQ, dude, I would be ready to short the market pretty hard in 2026.
But I like the way, regardless of how you want to do it, what I like about your approach is I don't trade my opinion. I trade the price. I trade risk action. And if I do have an opinion, I make sure that my opinion has an insurance policy so that if I'm wrong, at very worst, I break even. or make a little bit of money the other way.
I hope so. And look, I'm going to do a shameless plug here because I've built a lot of content in the last like 6 months. I am trying to get as many people at least educated with like the most basic options 101 that I've got a $27 course called Practical Options. It's 4 videos. It's bullish direction. It's bearish direction. It's debit spreads. It's credit spreads. It walks you through a lot of the things just to take away some of the intimidation and the overwhelming nature of like all the language around options. And I call it practical for a reason. I'm trying to get anybody that knows nothing. And I literally taught this to a 90-year-old client of mine. And I also taught my nephew who's 17 years old. And so if I can find that age range, anybody can learn how to trade options. And so I approached it that way as like, you know nothing. Here's some basic stuff to understand to make you at least, you can have an intelligent conversation if you want to, but you can go to the chart and you can figure out where's that line in the sand? What are my pros and cons and consequences to this trade? What's my risk? What's my reward? What's my probability? And that's why I like options. You're trading like a 3-dimensional tool, essentially, with the ability to have a backup plan. So it's out there. I also give that away for free with some of my services. So anybody that's trading with me daily live, some of my alert services, I give that away for free and stuff.
Tell us a little bit about your services, where people can find you, and what's your latest projects.
So with Prosperity Pub, I have a lot of services right now. I'm doing an index day trading service that's called Daily Profit Play. I also do a weekly swing service called Waterfall Income. I have an alert service called Double Up Alerts and a newsbreaker service. So that's 4 deep. I've got scanners and alerts and all sorts of stuff. I'm on YouTube every single day. I actually collaborate with A1 Trading in the mornings around 10 a.m. And then I do my own session the final hour, which is from 3 p.m. to 4 p.m. Eastern time. So traders can always find me every day.
Can people tune in live to Chris Pulver on YouTube and you'll do commentary? What do you do at the 3 o'clock hour? You talk about trade?
I literally, I'm just hunting for trades, man. Like I've got trades that I'm managing. I'm combing the portfolio every day. If I find trades, I take trades and I post it. So, I mean, traders get a lot of free stuff out of that, which is totally great. And then you want the more, you want full education, strategy guides, educational pieces, live trading room sessions and strategy specific things. That's what I run services on. But every day I'm live for that reason. It's like, I'm just out there. I mean, Boris, you've been in education for a long time. I've got a decade plus in it. And I know that there's a lot of traders that still need help. And the nice thing is it's popular to trade. It's great to trade. The resources and tools that we have now are as good as they've ever been. And they're probably going to keep getting better. And the permissions might even get better. And so as a trader, it's like, man, take advantage of this stuff if you can. And it's not that hard to figure something out that works. And that's what's exciting is like, I just created this content piece called One Trade Mastery, which is, look, obviously I'm talking through a lot of different strategies. I don't have a one trade. That's all I do. But if I had to do just one thing, I know what that would be. It would be something so basic like a credit spread in an index forever. And that's all I would ever do. It's a cheap way to dollar cost average and using options.
Yeah, meaning that you would just sell a put, you sell a put credit spread, let it come to you. And if it doesn't come to you, you just collect the money because the position is that over the long run, equities are going to rise, and you're just playing against that gradient. You're just playing. And there's 3 things they're going to do. They're going to drop hard, they're going to range, or they're going to rise. In 2 out of those 3 scenarios, selling credit spreads will win you money. And yeah, I mean, it's great. I agree. I mean, to me, if that is the retirement strategy, in my opinion, I agree.
For sure. And when I'm ready, like, I'm never going to stop trading. Like, I'll be dead when I stop trading. But I do know that when I get more passive and I'm ready to like pseudo retire, then it's a lot easier to be more like passive and kind of hands off. Where it's like trades like that are very easy and very systematic.
Awesome. Great. Well, what a wonderful conversation. There's so much here that my head is reeling. All the information that I learned from you, but it's really, really fascinating, amazing information. I hope everybody enjoys. Please, everybody go out there, tune in. I'm going to tune in tomorrow and say hi to Chris Pulver on his YouTube channel at 3 o'clock in the afternoon, New York time, which is the final closing New York trade. Otherwise, everybody, please come and make sure you subscribe to the Trading Battle, because we're going to have more interviews this year for you. As you can see, the content is amazing. Please join us. All the great content is just for you. This is Boris Schlossberg for the Trading Battle. Wishing you guys the best in the markets. I'll see you in the markets. Over and out.